Nerd alert! Property Nerds, the home for data-driven property investors, where we uncover Australia's hot and cold markets, latest headlines and trends.
Welcome everyone to another episode of the Property Nerds podcast. I'm your co-host Arjun Paliwal, CEO of InvestorKit Buyers Agency, and I'm here with my other co-host Jack from Fouracre Financial. Jack, how was the Australia Day weekend, mate? What did you get up to?
Not much, mate. Just spending time with the family, trying to get some time off. It's good to have a bit of a relaxing time.
Yeah.
What about you?
Is that your chill one? Just
Yeah. With 2 kids under 2, mate, you just want to relax.
Yeah.
What
Nice.
about yourself, mate?
Nice.
What are you up to?
Mate, we had the trip to Darwin. So random place for me to go to, but essentially one of the things my wife and I always do every year is we say every year, because we got married on the Australia Day weekend, we'd say we want to go to a different part of Australia that we've both never been to. And it just popped up as one of the things. And there's a bit of a joke to why we go to Darwin too, because I'd say maybe like 8 years ago, I was at CBA and I had this thought of like going, I want to move away from the head office back into the sales side of the role, and leading teams and all that sort of stuff, and move away from the research or product role. And then I saw this opportunity come up in Darwin, and it was an ANZ business banking manager role or something like that. And so I applied for it, but without my full heart. Like I was just like, I chucked it in just for the sake of like, we'll see where it goes. But I still wasn't like sure. So I didn't properly put everything like cover letters, thoughts, any detailed notes. But it's just one of those moments we had when we were talking about Darwin to go, holy crap, what if it progressed and I decided to go for it? Where would I have been today? Like I would have been in a completely different spot. Look, I would have gone to Bali like 10 times over, that's for sure, being what, 2 hours away or less or something. But it was a crazy memory. But yeah, that's the Australia Day weekend for me.
It's funny, man. I'm actually scarred from going to Darwin. My dad, when he was in his early 20s, he got a work opportunity up there to go and be a labourer, and he was just digging holes in the heat. And he said, he just always said, never go there. It's, but long time ago, after watching that show Territory on Netflix, it's all about these farm owners in Northern Territory. I'm like, you know what? Might have to go up there soon.
Yeah, it's a good amount of land there, that's for sure.
Yeah.
That's for sure. Well, mate, I know everyone's cracking into 2025. We're January down, and people are wondering, like, what's the go for property this year? What are some of the trends? And we've just put together a research report called The 7 Trends That Shape Australia's Property Market for 2025. And the cool thing about this particular report at InvestorKit is that this is the 2nd edition. So we did one last year. And the thing with reports like this is it's all great to go, ooh, here's my crystal ball, here's a bunch of trends. And then, you don't get pulled up on it because it's the first release. But this is the 2nd release. So in this actual research, we go, hey, last year we said this. How much of that happened? What happened? And we're just talking about macro trends of what went on for 2024, but also what's going to go on for 2025. So, and I thought in this podcast, me and you could crunch through a couple of them and just chat through, how many do we want to give away? 3, 4, 5? I reckon we'll talk about 3 of them, hey? We'll keep this podcast episode nice and tight today so we get 3 of them and give everyone an opportunity to go favorite this, download it. And you can find it, by the way, for those listening in or watching in, that's on investorkit.com.au. And it's the 7 trends that shape Australia's property market in 2025. So big shout out to the research team. Obviously, myself, head of research, Jung, our senior research analyst, Grace, our research analyst, and us, our data scientist. So excited to pull this one out. So what are your thoughts so far, mate, in terms of some of the trends you're seeing? And then I'll jump into a few of the things that we're seeing here as well.
Yeah, I think obviously with interest rates, even just being talked about coming down, I'm starting to see a lot of people come out of the woodwork, and that the sentiment is already changing. I mean, the rates haven't gone down, but just the talk of it, people are starting to come back and get ahead of it, which I think is a great idea. So I think that's definitely one to point out for this year for sure.
Absolutely, mate. Well, good news is that's trend number 1. So I'll shout that out.
I didn't know that.
You actually didn't, actually. So fun fact, he hasn't read the research paper yet. We're going through it together. But interest rates are set to decline, further boosting consumer sentiment. So that's the thing we had. And the key thing to point out here is that the economic data on all aspects has been trending down heavily, right? So we had our monthly CPI indicators and underlying inflation data points. Those two trends differ slightly. That reached a peak of near 8% or just under. And that was around January of 2023. So that was when that peak reached, and it's been free falling since. Now, yes, you'll look at different measurements and look at it how it's going, but if you take that monthly CPI indicator, we're at about 2.1% when we prepared this data set for the October ending release. So that's well in that range. If you're taking that underlying inflation indicator, it's at 3.2, 3.5%, depending on the data sets there. However, both indicate a free fall and both indicate we're at that RBA range. So yeah, the thing is rates are coming down this year. There's no question about it, right?
So what do you think is going to be more significant with the rates coming down? Do you think it's the sentiment, or do you think it's the borrowing power coming back?
I think the sentiment plays a big impact, right? Me and you both see this. There are so many people sitting on the sidelines that probably can, but don't. Yeah. And they're waiting for it. But really it's like the borrowing capacity difference it makes is going to help others be in competition with them rather than help them because they already could. So I think that's probably the first part. But I guess the main thing here is that it's clear there's two things changing. Interest rates are going to come down with inflation, the way it's been coming down. But the second thing is there is a big spike in sentiment starting to come together. Yeah. So we track the Westpac Melbourne Institute Consumer Sentiment Index trend. And, 2023, I'd say 2020, firstly, COVID, the lows of since the sentiment tracked. It was like in the low 70s. So that's the lowest it's ever been. Then you'd go to 2023, interest rates start coming down. I'd say in 22, 23, that inflation and interest rate combination starts causing a huge impact here on sentiment, and it completely falls off. And in fact, funnily enough, the lowest rates, all the stimulus cash checks, everything going crazy, 2021 was the highest it's ever been, the sentiment index. Now it's roaring back. So we can see 23 end at 78 and going up to about 95 with the latest data. So it's trending back up. So this means even though rates haven't come down yet, people are thinking that they will, and people are acting, starting to look at, starting to, be and feel better. And we all know there's this three fundamentals of property: demand, supply, and confidence. Yep. And confidence is sentiment, and that's a big one that's turning around. So yeah, it's going to be interesting times. But let me give you a couple of other things. The banks forecasts. Banks love to forecast. They don't get it right a lot.
I was just about to say that. Take it with a grain of salt.
Absolutely. CBA, next cut Feb, and they reckon it'll be down to 3.35 by end of the year. It's currently 4.35.
That'd be nice.
Westpac reckons cuts in May alongside NAB and ANZ, and Westpac reckons 3.35 by end of the year. NAB is interesting. They go 3.1 by June 2026, and ANZ reckons 3.85. So we're talking about 0.5% up to 1.4% drop in cash rates, depending on which forecast you take, is the estimates here. So that's kind of what we're seeing in terms of trend one. And the main thing is we're going to see finance commitment data start to change as well. Yeah. So that's trend one, mate.
Do you think that's just a coincidence that when the rates are coming down and the sentiment's talking about coming back, that's coinciding with a potential Sydney and Melbourne boom?
Good question.
Is that just a coincidence? Because people would say that high interest rates affects the high end of the market the most, which makes sense from a borrowing capacity point of view and affordability point of view. But is that just a coincidence, or are they tied together over time if you look at that?
Yeah, it's a good question. So what we have is, firstly, there's this notion that interest rates equal boom or bust depending on where they go. It's not the case.
Obviously,
that's the first thing,
obviously.
Right?
In the last couple of years, mate, I've seen the valuations that we're getting back from clients that have purchased in the last 2 years. There are definitely markets that have been booming.
Absolutely. So that's the first thing. When you're making this decision, blanket approach is not a way to go. Yeah. There are some markets with weaker fundamentals that actually didn't do well, even though interest rates went up. And there are some markets that crushed it. Yeah. So on the opposite, the same can be said as well. It's not going to be a blanket approach everywhere. Just because a market crushed it whilst interest rates were going up doesn't mean that it'll continue crushing it just because they came down. I think the first thing to say is that there's market sensitivity, meaning the places with, yes, the highest stretched percentages of income that go towards repayments, they feel the ease the most. And so Sydney and Melbourne just happen to have that. So I feel like, yes, they will be a lot more sensitive to finance data because that borrowing capacity change makes a big difference to their repayments. And we have a research paper coming out next month in Feb, and that's called our undervalued overvalued index. And that undervalued and overvalued markets, we track household income, we look at the actual repayments that they make towards the average price in that city. And so we're localizing it. And we see some cities like Sydney and Melbourne often stretched on these data sets. And so that does mean that they're more sensitive to when money changes the cost, right? And then it makes it easier for them. So yeah, I think they're going to be more sensitive. But I think in terms of when boom times come for them, you have to look at the 5-year supply trend, right? If you have interest rates getting lower, sure, it might make it more comfortable for a few people. But if sales volumes are nowhere to be found, if listings in terms of their 5-year averages are still high, pressure's not there, meaning growth doesn't occur. So we need that to change. So that's trend 1. If we look at trend 2, we'll go in order actually. Demand will continue to favor affordability, right? And you've noticed that as well. I mean, what are you noticing on that affordable price point of the market when you're doing valuations, finance? Why do you feel, firstly, that's picked up the way it has, in your opinion?
Yeah, so, I mean, it's hard to find a good property under 500K now. I remember when I bought in Townsville a couple of years ago, and I bought it for like 400,000 or something. It's close to 600 now. So I wonder where that next market is around that affordability that you can still get a good property, because I'm seeing less and less of those types of purchase prices now. So yeah, it's a tough one.
Yeah, I think the prices themselves, like you're definitely jumping a ring. What used to be the 3 to 5s is now the 4 to 6, and it's probably getting to the 500 to 600 numbers, right? But what's interesting to see is that whilst we sit in this high interest rate environment, it's clear that the affordable markets are the winners.
Yeah.
Over the last few years, we tracked something called quartile pricing, and those lower quartile prices of markets have actually absolutely crushed it. So we prepared some data here. Under 500K indexed growth averages. So basically what we did is we said, let's put all of Australia's SA3 regions, call them councils just for people not familiar with that term, slightly different in measurements, but much the same in some areas. And we grouped them into 4 buckets. All of the SA3s with median prices under 500K, all the SA3s with median prices of 5 to 700K, all of them with 750K to $1 million, and then all of them over $1 million. And we started the timer at, May of 2022, sort of when the interest rates started picking up. Check this out. Under 500K groups of markets grew by 26.9% since May 2022 on average. It's massive. I mean, some killed it even more than that. Over $1 million, minus 2.1%. So since interest rates have increased, the over $1 million market on average, if you grouped all of them together, have decreased by 2.1% using our data. The affordable, 26.9%, and it's perfectly in order for the next, meaning 15.6% for the 500 to 700K, the 12% for 750K to mil. So what you can do looking at that is you can basically look at this and go, well, opportunity or boom time still continuing? Well, as long as the costs of money remains this expensive and the fundamentals of those affordable markets are that undersupplied, the affordable markets are going to kill it again in 2025 and they're going to continue strong. And that seems to be the case because the pressure in Australia is the highest across Queensland, SA and WA, and they happen to be the most affordable markets in the States. But for those who are trying to go, well, what does the other side of this interest rate decline look like? What is the other side of improving fundamentals? What is the other side of like quartiles coming too close together? Like the 500K market here and $1 million market here, and it becomes here, it catches up to it. Yeah. Well, that represents opportunity. Because if a market in that 750K to $1 million price point hasn't grown much over the last few years, that's a buyer's market. That's an opportunity. So that's kind of what we're seeing on trend number 2. Are you seeing on the finance front, like also when people are coming for multiple purchases, just because they're in this interest rate environment, like that third or fourth purchase can't be that $1 million loan or 800K loan? Yeah. Are you seeing that too?
Yeah, 100%, man. Like borrowing capacity is what stops most people, for sure. Yeah, so yeah, that's why a lot of people are looking into SMSF and trust, but yeah, to try and get $1 million property for your third or fourth, you'll be on some pretty good income, that's for sure.
Yeah, I think that's another reason, right? Because the borrowing's stuck where it's stuck. Like people who are active investors are kind of going, well, yeah, I'd love to purchase a bigger price property, but just can't. And so it's almost this forced demand into that area because people just can't, right? So, mate, that's trend number 2. So that's the affordable areas that are likely to pick up a lot, and I think that's going to be another year worth of that, because even the interest rate declines that are due to happen, they won't all come in at once. They won't all make immediate impact at once. But I think the affordable markets are still likely to go to that next level. So, mate, that's trend number 2. I might jump into one more trend here, Jack, and this is an interesting one, so that people aren't actually realizing still exists. Supply, trend number 5. So supply shortages will remain the primary driver of price growth. Mm-hmm. Now, when it comes to supply, the thing that people make the mistake of is they think supply is new build housing. Mm-hmm. Right?
I made that mistake a couple of podcasts ago.
There you go.
You educated me.
Yeah.
It's a good point.
So people think supply is new build housing. Supply is a combination of it all.
Yep.
It's how many established listings are for sale, and that shows you how many of the main property pool is for sale. The second thing is how many listings are for sale in comparison to how many sales occur each month. That's now net supply of demand. Then it's how much construction's occurring. Then it's how much rental supply is occurring. And then not also how much is listed, but how much is listed in comparison to the proportion of properties in the area. Because there might be 500 listings in that suburb, might be scary. But what if the suburb is like 20,000 houses? There might not be as much as people think. Or what if it's 500 listings but only 100 sales occur? That's a lot. What if it's 500 listings and 300 sales occur and it's tight? So I think the key thing is to look at supply in all of these ways possible, right? Now, when it comes to supply markets, I think the key thing to recognize here is that the supply levels in Australia are still substantially below. Like, to give you some context here, in 2019, the houses listed for sale were approximately 264,000 established. Whereas today, in November 2024 or December 2024, the last time that we checked this data, it was 203,500. So we're still having a 23% decline in supply, whilst we all know what's happened to population over that time, right? Yeah. It's been going up. And so I guess the major thing to think about is that until that number changes, in some areas that's changed, like it's not going to be like, suddenly the price declines everywhere. So, and to give you some examples of where it's the most prominent, like Perth, Adelaide, probably the 2 tightest capital cities. And then you have a trek down regional Queensland, regional SA, regional WA, again, very tight. So they represent sellers markets, growth rates are going to be high. But mate, that's what we're seeing on the supply front. I mean, what have you noticed on some of the supply fronts from some of your clients? How does it impact their buying times, like time it takes them to find stuff, pre-approval, renewing them? What have you noticed around this sort of like few years or a bit of...
Yeah, I don't know if pre-approvals, some expire, some don't. But what I wanted to ask you as well, do you think for the established supply, do you think the way that you solve that is to get rid of stamp duty and capital gains? Is that the 2 main things, or is there anything else?
Big difference. Yeah. That's going to make a huge difference.
Yeah, for sure.
Like, so what happens is...
It'll never happen. It'll never happen, dude.
If we had some long-term focused leaders, like, it will happen, but that's the problem, right? Where everything's a 4-year cycle. Everyone's get in, get out. Everyone's trying to get to that next job or next this. And look, stock mobility is a killer.
It makes sense. It makes sense.
It's massive, right? If you go, I've got 4 to 5% on the way in to make up.
Yeah.
Okay, that's already 1 year of growth, and long-term averages just to break even, not including any sales costs.
Yeah.
Then you've got sales costs that adds in another 2 to 3%, including lawyers, pest and building. So you're probably about like almost 1.5 to 2 years just to get the break even on your money with normal growth rates. And then you tell yourself, well, I haven't even started to think of tax yet. You've actually made no money. So I would say there's also no flippers now. The flippers don't want to flip as quick because they're looking at that.
Yeah.
So you'll just have way more mobility. Like, and also just if you have less friction in decision making, less calculations to make, you make a decision.
Yeah.
It's mindset and it's also like mobility, big difference makers.
Yeah, the capital gains tax seems to be the one that people cling to the most, but then they don't realize that when you get back in, you've got to pay stamp duty, which is huge. Like some people they go, what? 50,000 in stamp duty or 100,000 in stamp duty? And then some people are paying hundreds of thousands of dollars in capital gains tax. It's unreal.
Yeah. It's massive, man. And
at least it's going to a good cause, right?
Yeah.
It's not. I'm just joking.
Yeah, great cause. Absolutely. But I think like those changes, they make a big difference, but like they don't make a forever difference.
Yeah.
What I mean by that is like
yeah.
they'll normalize eventually. Yeah. Prices will meet that mobility. Because I always look across the ditch in New Zealand, right? In New Zealand, they don't have stamp duty, if I'm not mistaken. And I believe they don't also have capital gains tax. And they're still pretty undersupplied. And in some areas, a lot of price declines have been happening. Economy's been weak. Interest rates are now free falling there. So I get it. It's not been a good market in recent times. But if you look at those 10-year averages, growth rates have been massive, and they've not had those like constrictions of supply in that. So I feel like once it makes up a certain price point, people might hold on to things again, or it might be tougher to get into and buy. So I feel like that's definitely one thing. But I also feel like the something that's not talked about often, and I know it's a hard topic to talk about because it's such a big change. It's like Australia's population isn't as evenly spread, right? We have some of the most dense across a few major cities. And because of that lack of distribution, like there could be better opportunity for improved transport, improved distribution. And then as a result, when you're doing supply, right now when the towers come up or when certain house projects come up, they're only coming up into a few select cities and a few select hubs. They don't have that ability to go all over the place and create some more affordable supply in some areas. I know new build doesn't solve it all. It's established supply is where it's at. But yeah, the mobility will help. The distribution of our population all over the place will help better. The planning system to match what we have in some of our major cities across some of our other cities will help. Now, I don't know how some of the people in smaller cities will feel about that, but the truth is it will help because that is where cheaper housing is sitting.
Yeah.
And as a result, when jobs start spreading across the country as well, people then consider their work, their family, their play, all that sort of stuff happens. Yeah. And, people aren't competing for the same stock or the same product, and people have more desire to move. Right? So all of these things can play a part. It's not this one silver bullet. I think nothing will solve that long term as a silver bullet. Yeah. It'll be a short term. Stock mobility will help. A lot of people go, oh, I'm selling now. Yeah. I'll cash out. I'll move here. I'm going to go there. But long term, even they'll fizzle out over time.
How dirty would you be if you sold 2 years before they brought that in?
Yeah. Like imagine that. No CGT. It's like, what? But we just paid all this. Yeah. And I think like that holding period for people will continue to just be longer and longer, the more taxes, the more things sit in. Even just like the way when like the uncertainty around will I be able to get that next one because of all these costs and expenses? Like people like don't want to upsize or downsize in certain markets just because they see all these expenses and things tied to it. It just paralyzes decision making.
So we talk about this and the people in the government are actually talking about going the other way. Like actually more tax, more stamp duty, more capital gains. Like disheartening,
mate. It's look, all I can say is we're paying a fair share our way.
Oh, mate,
we're helping out.
I think GST is enough.
Yeah,
I think if you can't survive on 10% of everything, you got something going on, something wrong there.
I think one of the interesting ones, like how I'm starting to feel old now. Like I'm starting to feel old now. And you know what's making me feel old?
So you're paying attention to politics?
Yeah. We're talking tax. Mate. We're sitting at the table. We're talking tax. I'm sitting there. I'm like, I had this one moment with family. I was like, holy hell. Like I just realized we're paying tax to create jobs. I'm like, my brother's like, what? Explain that. I was like, I'm learning about this thing called payroll tax now. And we've been paying that. Our company's growing. We've got over 40 people and that number's getting bigger. Like, as a result, it's like, okay, you add the wages up, and if you have wages above a certain level totaled in the company, you pay payroll tax. And so like, I can't control it. It is what it is.
Yeah.
But the main thing is, I was thinking about it and going, hold on a minute. So the government goes, you pay tax because you're creating more employment in the state. And so to thank you for creating more employment in the state, here's some more tax. Like, where's the productivity in that? Like, I think there should be more incentives to go, Arj, if you're creating more jobs because people love the service at InvestorKit, they want to use more your services more, and then you need more people to help people use your services more, like incentivize me for that. But look, that's my old man story, sitting back and complaining about taxes and all. But any other taxes, look, I think anything you can change in the property market in terms of that increases mobility. And mobility moves listings, and I think that's a big thing. I also think, like, on that listing front, like, yes, our building approvals are much lower, but people forget building approvals are just one thing. You have to go to start, you have to go to progress, you have to go to completion, and builders are getting impacted. They're not finishing the whole way through. Many going into liquidation. People land banking, not starting until it makes sense. So there's just a bigger problem going on here. But the main thing is supply shortages, wherever you see areas with them, which reminds me, if you want to check out another free research paper, we talked about this in a previous episode. It's our supply shortage score, 25 most undersupplied markets. Just got featured in the Courier Mail, Real Estate, News.com domain about the 25 markets that we will have the highest levels of growth in over the next 12 months, simply because of how undersupplied they are. So, mate, that's it. 7 trends that shape Australia, and that's 3 of them. Supply shortage remaining the primary driver, the interest rates and how they are faring this year and what's expected, and then also the affordable locations and what they're going to do and how popular they'll be for the next 12 months. So check it out if you'd like the other 4 trends, where we go into more about the rental market, go into certain migration trends and what's happening across different parts of the country. And that's investorkit.com.au, 7 trends that shape Australia's property market in 2025. Totally free to download. Go and check it out. Thanks again.
Game over.